I'd like to introduce Matthew Tang. He's the Client Director for Tisch Global Corporate Advisory, who will be your presenter and your trainer today. Over to you, Matthew.
Thank you, Danny. Thank you. Thank you so much to AWS as well as to Scape for giving me this wonderful opportunity to share my experience as well as to give some insight. When I was first approached, I honestly didn't know where to begin because there's really just so much to share about investors, about becoming investor ready, and about startups in general. Especially right now, we're in this climate where we've actually been able to come across, and it's so different, right? The current COVID-19 climate has changed things so much. And I think I would just like to share, from my perspective, I think my purpose today is to share from my perspective how companies or startups can potentially become investor ready. Why do I want to share this? I think it's important during this period and during this climate, especially if you're a company looking at raising funds, to be able to leverage on the best opportunities and to be ready. I mean, I was on the other side of the table myself as well. I was on a fundraising road as well, and I would really like, from my own personal opinion and on my own personal view, to share my experiences. So every single one of you in this room today would take back something that is useful for yourself. And if you do run a startup and if you do run a company, please feel free to take down notes, reach out to me, and I will be glad to share my experience with everyone. So before we begin, I think I have actually have just a short poll for everyone here, just to get myself acquainted with you guys and just to find out about where everyone is at right now, so I can tailor the session. And my intention for this session today is to really make it very interactive. Right? What do I mean by interactive? So if you do have any questions, if you do have any suggestions or anything that you have on your mind, as I go through my sharing, please, as Danny mentioned previously, please feel free to go down to the chat and type down a question. I would actually like to address the questions as and when I go along my sharing, so that it will be a lot more useful and I can target and I can look at these questions and address them as quickly as possible. Okay, just let me go into my slides over here as well, and there'll be another area that is that will provide you the opportunity to ask questions, and that is a Pigeonhole link over here. Okay, so if everyone has, I think probably no one is stranger to Pigeonhole right now. Yeah, so if you do have any questions, either do it on the chat or do it on Pigeonhole. Okay, good? All good? Okay, so I just would like to launch the poll as well very quickly over here. And just to get a sense and get a flavor of where everyone is at right now, so I can tailor my sharing accordingly. I'm just going to launch the poll. So if I can get your help to just click on the poll and answer those questions accordingly. And I'll see the results as they come. So let me just go through very quickly here. Firstly, I would like to know who you are, right? As an individual, who are you? Where are you at right now? Are you a startup founder? Are you an SME owner? Are you an employee, or are you a student just attending the talk and just understanding, trying to understand what becoming investor ready is all about? Okay, and no matter which stage of, no matter your profile, I think it would be extremely useful to stay on in this sharing, because I'll be sharing a few things over here, including some tips to engage with investors, as well as to how to become investor ready from my own experience. Okay, the next question I have here is, what is the current state of your company? All right, is it pre-revenue? Are you an early stage startup? Are you an SME? Are you a large local enterprise? Are you coming from MNC, or not applicable? You're just here to learn a bit more. Okay, thirdly, at what stage of funding is your company at? Okay, I think we are also no stranger nowadays. If you say these terms, probably 10, 15 years ago, people don't understand what this means. But today, I think everyone knows exactly what series seed round, series A, series B, so on and so forth. And there's so much news right around today. So what stage of funding is your company at? Okay, and would you consider tapping on both, right? Debt, equity, or both? Or is it not applicable to you? Okay, wow, okay, thank you everyone for the warm participation. If I can just get a few more people to come in. I think there are one or two people also trickling into the poll, but definitely thank you for your participation. Great. I think I see really a wide range of people over here. So a large number of students and startup founders as well. There are some employees here also who are keen to know more. In terms of startup, really a wide range as well, pre-revenue all the way to SME and MNC. Okay, what stage your company is at? I think majority are not applicable, but there are some seed stage founders here. So I think you guys definitely will be able to benefit from this session greatly. And what form of financing we tap on? Okay, interesting. 0% debt. Mostly equity, mostly not applicable. I think maybe I can also share a bit more. No worries about this. Okay, thank you. So let me just go straight in. Okay, just a typical disclaimer. Yeah, all things are shared. That's my personal opinion, and we're not really pushing any instrument over here. Okay, standard disclaimer. Okay, so what do I do? First question, who am I and what does Tisch Global do? We are corporate advisory. So what we do is that we specialize in startups and SMEs. Startups and SMEs are our clients. The reason why I started the company and the reason why we started on this journey as well was really to ensure that the startup and SME sector gets served. In case you don't know, probably just a guess. You don't need to shout this out, right? But just a guess. How many of countries? Okay, what proportion of a country's GDP is contributed by startups and SMEs, right? Is it 30%? Is it 50? Is it more than 30%? Is it more than 50%? Is it more than 70%? How many people in an economy? What proportion of people in the economy are employed by startups and SMEs? Is it more than 30? More than 50%, more than 70%, more than 90%. Okay. In fact, more than 50% of a country's GDP is supported by startups and SMEs. And if you did not know this also, something also to take note is that more than 90% in some countries, in some ASEAN countries, more than 90% of individuals are hired by a startup or an SME. So we are seeing a huge number of people being hired by small and medium enterprises as well as startups, as well as a large number of people who are looking at who are being employed by them and also contribution to GDP. So that is why, from a personal point of view, this is why I looked at serving this segment, and we have really achieved quite a remarkable results for ourselves. More than $9.5 million in capital raise. Our client portfolio valuation is really quite high. And for clients, year-on-year revenue growth when they've come on board with us is 7 times. Yeah, so you can see over here, the industries we serve are really a large number of industries. And we do have a number of financial institution partners as well. So that's something that we are really good at, making partnerships. And things like that. As for myself, a little bit about myself, I am the client director of the company, but I also have been on the fundraising road, just like some of you as well. So I was also curious when I started, how did companies raise funds? How did startups and SMEs get so much funding? How did they do it, right? If you look at the papers, you see success stories of companies, big companies like Grab, even recently Go raised a huge round. You see other companies coming in and raising funds, but there are a lot of companies as well who are not successful and don't make it. In fact, VCs do see presentation decks, and I'm pretty sure they do see more than 1,000 presentation decks probably, and I think some of the guys who are in the sector here can attest to that. They do see a large number, hundreds and thousands of decks every year. So how can you as a founder or as a company take advantage of this and raise funds for yourself and become investor ready? So that's what I would like to address today. Okay, just a little bit about the company, also the services that we offer: financial advisory, management consulting, capital raising, entity formation, accounting and finance, and tax advisory as well. So this is pretty much what we do. And in my course of work, we interact with a lot of startups, SMEs, almost many of the VCs as well. So I think this will be a good sharing for everyone. Just also a brief introduction of the clients who trust us. We can see over here quite a large number of startups as well. So you can see here companies like who have raised a significant Series A seed funding rounds as well, and a large number of SMEs over here, really across a range of industries. Okay, so this is what I will briefly share. I think it's useful for us, especially in this region over here, to get a brief description and an understanding of the funding landscape. Now, why is this important to you? As a startup founder, as a company founder, or even as an SME owner, you will want to understand what is out there. What are investors doing? What is the appetite of investors during this period? What are they looking for during this COVID-19 times? And how will it impact your company? Right? And even as a student, it is important for you as well to understand where the funding landscape is headed towards. So upon graduation, you will understand, well, firstly, do you want to set up your own company? And how can you potentially raise funds for your company? And also moving forward, how this would affect employment, right? Would you want to go to a capitalized startup to work? Or would you want to start from a pre-funded startup to start working with them? So this is absolutely important and essential to understanding the funding landscape in Southeast Asia. Also, I'll share 5 pointers to become investor ready. Five very simple tips through my own experience of working with working with startups or raising funds to expedite the time that you can use to raise funds. And I think this is important for those company founders. Thirdly, understanding the types of funding, right? Debt, equity, and the rise of debt as an alternative source of funding. I think something that a lot of probably corporate finance guys here who, if you're doing finance as well in university, you'll be interested to hear. Fourthly, 5 tips to engage with investors. So these are just some tips that from my own experience, whether it will help you along the fundraising road, I think this will be absolutely essential to have. Okay, and the last one will be a Q&A segment. I think I want to open up the session also to the Q&A segment as well. So if you do have questions, keep them coming, keep them flowing. Do type them in the chat box, or go into Pigeonhole to raise those questions up, and we'll be addressing them as we move along. Okay, yeah, so let's keep it casual. Just trying to understand. Just let me go to the next slide. So the Southeast Asian investment story, you might be wondering what's so special about our region? What's so exciting about Southeast Asia? What I can say is that Southeast Asia actually right now is the #1 region for investment globally. And I think this is in line with the whole overall theme of ASEAN and the theme that is under the AWS banner right now, right? Southeast Asia is a region of tremendous potential. And from my conversation with investors, especially investors in Asia and investors in the US, this region is the region to watch out for. You do see, and if you don't understand, recently in the news, we have a lot of developments in the US regarding special purpose acquisition vehicles, acquisition companies or SPACs. A lot of them are looking at Southeast Asian target companies. So we have Grab, going to be one of the largest SPAC acquisitions going on. We also have Gojek and Tokopedia, some of the other larger ones going on as well. So it is a region of tremendous potential. And I think all of us here who are in this region will be able to benefit from the potential and the growth of this region. I think all of us, probably most of us, are in this region situated over here. 30-year-old median age of Southeast Asia population, I think one of the youngest as well around the world. So spending power is high, a fast-growing workforce and growing middle class, and more users coming onto the internet. If you see last year alone, mobile internet penetration, more than 40 million users came onto the internet for the first time in 2020. I think also expedited by the COVID situation when everyone was at home and probably under lockdown, and then I think somehow a lot of them came on the internet. But you get the point, right? A lot of more and more people are coming on the internet, and the region here is a tremendous region for growth. So I also like to look at the number of something that we've looked at and we studied. The number of Southeast Asian focused funds, right, have increased, in fact, 1.4 times over the last few years, right, the last 10 years. If you see over here, what this means is that investors with, and every investor has a specific mandate, right? Investors with a specific mandate for investing in Southeast Asia, they will open up a fund, and the number of funds have increased 1.4 times. So you can see the focus of Southeast Asia as a region is tremendous, and they understand the potential within Southeast Asia. However, we do note that the Southeast Asian funding landscape is in fact maturing, right? We can see here two slides over here. On the left is a line chart. What does this mean? The average number of months before the close of the previous round. So the average number of months between raising a seed round and a Series A round, and the average number of months being raised between a Series B round and a Series C round have dropped 22%. So this means the number of months between funding rounds have dipped, right? This means that, well, number one, investors are a lot faster in deploying capital. But at the same time, investors are also looking at capital and also a lot more picky when it comes to capital, right? So we see that it is maturing here on the right. On the bar chart over here, what we can see is that a sign of a maturing ecosystem. Late-stage deals, more than 60 million, have also progressively increased by an average of 1.6 times year on year. Now, this means that the ecosystem is maturing. Investors are becoming a lot more sophisticated. Investors are becoming, they know what they want when they're investing in Southeast Asia. And why is this important to you? Because looking at the funding landscape, you need to know exactly what you can offer to a particular investor when you are asking for investment from them. And you must clearly define what your company is and what your value of your company is in order to get the funding. And if you do get there, they can deploy funds very quickly. Case in point, recent example that I had also, I was working with a client, and actually clients based in Southeast Asia, but they have a very interesting business model. They are in a different industry. They are actually in the pet care industry, and they have successfully raised some money. But for them, initially when they started to raise funds, I think they approached investors in Southeast Asia, and some investors, a lot of them were very keen to meet them. Yeah, but as they went along, I think a lot of investors didn't know how to view the company and weren't familiar with the industry as a whole. But they actually got funded eventually by some of the top VCs within the region. So we can see here that investors are a lot more sophisticated when it comes to funding, but at the same time, they themselves are also becoming a little bit picky, right? So I think what we can do is you can address this as we go along. Later on during the sharing, I would address some of these issues that come about. Okay, and at the same time, I think for the founders here who are also not within the region, most investors actually prefer a Singapore holding company. Right. So if you are based, for example, in our neighboring countries, our neighbors like Malaysia, Vietnam, the Philippines, Indonesia, at times do tap on. Most of the investors are actually based in Singapore, right? A lot of companies have set up single family offices based in Singapore, VCs based in Singapore. Do come down here and engage with investors, because a lot of them are interested in such emerging economies, but they also kind of prefer a Singapore holding company. So establish your base here as well as early as possible when you are interacting with investors. Then that is key. And why is this so? It's because we have a very good regime, and I think I won't really bore you with the details of some of the regimes that we have, but just off the top of my head and just very briefly over here, there are two regimes that we have: the VCFM regime as well as the SFAC regime, the VCC, Variable Capital Company regime. And because of these two regimes, what we can see here is that a lot more investors will be coming in to set up base within Singapore. And as well as the number of single family offices have boomed over the recent years. These Singapore family offices are based within Singapore because there is really what MAS terms as a light touch regulatory regime, right? So it's very easy to set up a family office here, very easy to re-domicile your assets over here and to take advantage of various tax incentive schemes as well as tax exemptions for Singapore, for within the Singapore region. So what does this mean to you as a startup founder? I think many of us here would be able to understand and to get familiar with startups and companies. But what does this mean to you? Number one, investors are becoming a lot more sophisticated, like I mentioned before. They can deploy funds quickly, but they know exactly what they want. They know exactly what they are investing in. And they need to know exactly who you are and what your company offers, right? And I'll cover this later on in the five tips to become investor ready. Thirdly, consider corporate structure early. Okay, when we are looking at corporate structure, when we are looking at how to structure your company, as well as understanding which shareholders are within the company, understanding how to visualize and how your company will move forward in future and how your company will grow in future, do think of this and do plan it early in the stage of your company, right? So take, for example, if you are looking at hiring individuals within Singapore as well as an overseas base, how would you want to hold this? Would you want to incorporate a subsidiary company that is based overseas, for example, in Indonesia, and then incorporate a holding company in Singapore? Right, and what are some of the tax requirements, tax regime requirements, and how would you receive money? I think these are some of the important things that you should consider early. And thirdly, also be prepared for alternative deal scenarios. I think I really cannot emphasize more on this point. Alternative deal scenarios do come as you negotiate and as you bring your company through the fundraising process. People are going to come at you with different kinds of terms and different kinds of things that they want from you. And from my own experience, play this on your mind, prepare for these scenarios, because it will make your fundraising journey a lot smoother. And I'll elaborate a little bit more about this, right? Okay, so I will just dive right into the 5 points to become investor ready. I think that's absolutely important for us as we move along in our investment journey and as company founders, to be able to understand how we can be investment ready, how we can become investor ready. The first one is, I think I cannot emphasize more. As a company, understand what you're selling. Okay, understand what you are selling. Sometimes, from my own experience working with founders and my own experience working with business owners, sometimes we are too ingrained in the operations of a business that we kind of lose track of where we are at with the business, right? We kind of lose track of what we are actually selling. Well, so the first question I'll ask you is, are you selling a product or are you selling a service, right? So are you selling, what I mean by that is, are you selling a service that is rendered, okay? Or are you selling a product? So it could be technology. I mean, when I say a product, it doesn't mean that it's like a physical product, right? But it could be a subscription service, or it could be a software subscription. Are you selling a product, or are you selling a service? Okay, this is very important because it affects your valuation as you move forward and as you raise more money. Okay, and I'll wrap this up with an example later, and I'll just give you an example of how this goes about, right? Secondly, are you technology based, or if not, how does technology contribute to your revenue? Okay, investors need to know this, and it's absolutely important to define to investors: are people giving you, are customers engaging you, and is technology merely a byproduct of this engagement, or are customers actually using technology to engage your service, meaning that your service is technology based, right? You are rendering the service using technology. So these are two very different things, right? And it affects your valuation, because if technology is just a byproduct of what you're providing, meaning that customers don't necessarily engage with your technology stack, your tech stack, and they come to you and they try to understand and they engage a service with you, and technology is just a byproduct, then this really will affect your valuation, and you have to be prepared to answer these questions when you're engaging with investors. Make sense so far? Okay, and let me give you an example later on about really a case example of what I've did. Okay, and thirdly, investors love recurring revenue. So how are you presenting your revenue to investors, right? Are you presenting them as a recurring base, meaning that is it a monthly subscription, or is it only service based, episodic, meaning that every time a case occurs or every time an event occurs, only then will you have revenue and money coming in? What is driving your revenue in general? Because investors love recurring revenue, right? They want that, and recurring revenue brings scale and brings growth to a company, right? How about the last point? Good to have versus must have. Yeah, good to have versus must have. What do I mean by this? Is your service or is your customer coming to you because it is good to have service or good to have product, or is it a must have, right? Be very honest with yourself and think about it. If the potential idea that you're thinking about is only a good to have, right, then the dropout rate in future moving forward could be pretty high versus a must have, right? Versus a must have. Okay. Just let me give you an example over here as well of what I mean by, are you selling a product as a service, or, is your product technology based, and how does your technology contribute to your revenue? Let me give you an example over here of, if you can see here, it's a healthcare company that I looked at as well and working with. So if you can see over here, how they presented the revenues initially to investors was through a very static way of presenting it, right? So 2018, 2019, the number of visits and the amount per visit, which will get to the entire revenue amount over here, right? The number of units, and then per unit subscription, and then the amount of revenue here. So this, essentially this, adding on to this will tie up with this. Okay. There is one drawback though, and I'm not sure whether everyone can see this. You are presenting, well, firstly, your numbers in a very static manner. And secondly, this was actually a health tech company. So where is your technology? How are you presenting your technology revenues, right? Are essentially individuals engaging your service because of the technology, because you're providing a good technology base, or are you actually, or is technology a byproduct, meaning that, okay, you're using technology to become more efficient, right? So it's, if you see here, it's not apparently clear, right? This is not apparently clear. And we don't see the number of the growth, right? The month-on-month growth as well. They didn't present it to investors. Okay, so what we did over here was to look at revenues and really break it down into individual drivers of revenues, right? So the number of corporates and the number of employees. And you can see here the month-on-month growth, right? And if you look at the the revenue driver over here, I'm becoming slightly technical as well. Sorry, but I think this is really quite important. If you look at the revenue driver over here, this revenue driver is driven by the increase in the number of corporates and number of employees. So we are breaking down the revenue into bite-sized pieces to enable the investor to understand how and what drives this revenue. And what drives this revenue over here is the increase in the number of corporates, number of employees, as well as moving forward, increase in overall volume, right, of the number of cases that we do, even though average revenue per case has not increased. Okay, so it is extremely important to know how and to define why you and how you derive your revenues. Okay, so that's really the first key takeaway. Okay, the second one is understanding your revenue model. And I think I get this question a lot also when we go on the fundraising road, right, with companies. One question you should be prepared to answer is, how long is your sales cycle? Yeah, how long is your sales cycle? So how long does it take for you between the time of prospecting all the way to when the time you are closing your sale? Now, this is very, very important because it really highlights the kind of churn or the kind of turnover that you can potentially get for your sales, right? So how many customers are coming, how quickly customers can come, and how quickly you can close sales. Do take note, right, that for consumer-based businesses, I think how many of you here are based in consumer-based businesses, right? B2C businesses, right? You understand that consumers come and go very quickly, right? So your sales cycle might not be too long, right? As opposed to some of us here who have B2B businesses, right? The sales cycle could potentially be very long. It could be for a big ticket item, you know, something in hundreds of thousands of dollars. Your sales cycle could be 6 months to a year even, right? And it also depends on the industry. So how long is the sales cycle? This has to be defined. Secondly, when do you collect cash? Okay, as a business, collect cash upfront as much as possible. This will help with your cash flow very, very significantly. Okay, I think this is extremely important as well for companies who are first starting out. Right? As a young company, as a company coming in and trying to make your way and establishing yourself, cash flow is important, and cash is king, right, in accounting finance. So when you collect for cash, okay. Thirdly, most importantly, demonstrate scalability, right? Demonstrate scalability. The reason why I say this is you have to show how your company has the ability to achieve supernormal growth. Okay, and by supernormal growth, let me jump to my last point over here. Can everyone see here? Anyone has heard of this term called T2D3 before? T2D3. What is T2D3? Okay, T2D3 is simply if you want your company to become a unicorn, all right, triple your revenue in 2 years and double your revenue in 3 years. So meaning that for 5 years, for the first 2 years, triple your revenue, and for the next 3 years, double your revenues, and you're on your way to becoming a unicorn. Impossible, but sounds very difficult, but it has been done. Yeah, it has been done by a lot of companies. So this is the kind of supernormal growth that investors are looking for. Not only 2x growth, 3x growth, but 5x, 7x. So how do you demonstrate to investors that your revenues are scalable, right? So is it a software as a service kind of concept where as more and more users come on board, you get more and more revenue, right? Or is it a subscription model, right, for customers? So most customers probably would be they find it a bit cumbersome to unsubscribe, and then there you get your super revenue growth. But what I would like to highlight here is revenue quantum is secondary, right? Revenue quantum is secondary. Now, why do I say this? From my own experience, as well as from the time interacting with companies and startups, the quantum of revenue is really not important. I've known companies and I've seen companies with my own eyes with revenues that are really small amounts of revenues of pittance, but able to raise funds at a significant valuation. Yeah, so it's the numbers don't matter. The numbers matter. I wouldn't say it matters. Numbers matter to a certain extent, but the understanding of the business and the revenue model is key. Right? Revenue quantum is simply not very important. Okay. Okay, I think I have also one question over here coming up from the floor. Yeah, if you do have questions, keep them coming, right? I do see one question over here coming up in my inbox. The question here is, why are VCs picky? Why are VCs picky? Okay, I will address this right now. Okay, I think it's quite important, and I think everyone also wants to kind of understand the psyche, right, of an investor. Okay, think about it. What is the business model of venture capital, or what is the business model of investing in venture capital or in early stage startups? Right? What is the business model? A list of 10 companies. How many will succeed? Right? Only one, right? Only one. They're banking on one or two. One to be a 100-bagger, right? 100-bagger, I mean, valuation increased by 100 times, right? And you can say that you have increased in overall, 10 times and things like that. So they are looking at one or two moonshots, right? One or two moonshots out of every 10, okay? And when they are looking at these moonshots, what they would want to achieve, and I think a lot of my friends here who are in finance would understand, is diversification. They will want to diversify their portfolio, okay? And in order to achieve those moonshots, they have to pick the best companies or in their opinion, the best companies to invest in, right? So that is essentially why they have to be picky. And when you look at diversification, they will want companies who have, it could be a crazy business model that no one has heard of, but these companies are the ones that can make a difference. These are the companies who will give them this chance to become a moonshot, right? And not simply a simple kind of SME or like a company, right? So this is from the VC angle, okay? Right, so, yeah, so if there are questions, yeah, just feel free to keep them coming, okay? The third one is present your revenues as scalable, right? Present your revenues as scalable. So the ability to grow revenues is key. The one thing I always like to share is investors are not your experts. They are not experts in your business. You are, which is why they are investing in you, right? But you understand the nuances. What you have to do is to articulate and enable an easy understanding of revenues to investors, right? Use metrics like per user, per month, per quarter, things like that. Break down your revenues into smaller bite-sized pieces to enable the investor to project your revenues moving forward and to understand, right? So it could be like a per visit kind of thing, right? You charge $25 per visit. Simple as that. And the number of visits you can get, have been increasing 5 times, 10 times month on month. And by the end of the year, we are looking at revenues of 25 visits times 100,000 visits, right? 2.5 million. Yeah, there you go. So easy understanding of revenues is absolutely important. Okay, and understanding revenues inside out. How many are repeat customers? What is your customer lifetime value? So simply put, you should be able to, at the tip of your fingers, articulate where your revenues are coming from, who your customers are, which target segment you're serving, what is your customer lifetime value, okay? Get a very intimate understanding of these numbers. Okay, any questions so far? Are we good? Yeah, if there are any questions, yeah, feel free to, ping me on the chat, type it down on the chat, or look at even putting it down on Pigeonhole. Okay, and the fourth, and I think one of the most important thing is position your deal. All right, what do I mean by this? What do I mean by position your deal? The key question I will ask everyone here is, would you catch a falling knife, right? Would you catch a falling knife? What I mean by this, last year, COVID-19, right? Stock market plummet. Stock markets have been plummeting, right? Going down month on month. Would you buy something that is going down month on month? Would you catch a falling knife, right? Would you risk cutting yourself and catching a falling knife, right? The answer is, for most risk-averse investors, the answers will be no. Would you invest at so the next follow-up question will be, would you invest at a 50% valuation, at a 50% discount on your valuation? Okay, and the reason why I say this is because in my own experience with on the road with fundraising with companies and even fundraising on my own as well, at times as a founder, we might be tempted to do this one thing, right? Offer a straight 50% discount on valuation in hopes of attracting investors, right? You will tell investors, okay, I want you guys to come on board. I want you guys so badly to come on board. Well, no issue. Let me just give you a 50% cut on valuation, right? So the moment you come in, you are up by 50%. Is this a good idea to have? It's not advisable, right? Because during 2019, there are many distressed deals out there, many COVID-19 distressed deals, and you don't want your company to be positioned within those distressed deals. Okay, because the moment you do so, it is putting yourself within that area, and you will be among one of those few distressed deals. And do take note that the investor community is small. So as companies move, as investors spread the word, and I've seen decks come across my table as well, and that these decks are flying around, right? The investor community is small, so if you do share this and you put it somewhere in your deck, someone's going to pick it up, and someone might not potentially come in as well, right? Third one is leverage on herd mentality. Okay, what do I mean by this? What I mean is, as long as one investor comes in, you can see potentially the rest will come in and follow, right? Everyone just waiting for someone to jump into the deal. Okay, and this is case in point. Also, another one of our clients who have raised funds as well was having a lot of difficulty at the start, because I think the business model wasn't really proven, and I think in Asia, the market, the perceived market was pretty small. But what happened was, the moment one investor started to come in and say, I put money into your company, everyone else just came in after that. Yep. So you want to market and you want to share about this potential deal that has come in, and this commitment, this committed capital that has come in. But at the same time, it can hurt conversely, right? It can hurt you on another way also. Okay. It can hurt you conversely, because at the same time, once investors don't want to come in, no one will touch you. Yeah. So I mean, simply put, yeah. Case in point, also a recent example of a pretty highly capitalized company, or pretty highly capitalized startup, was on the fundraising road for close to 2 years and had a lot of issues raising funds, and had to sell one of their key revenue generating subsidiaries to continuously to invest, because the word has got around that it's going to be a difficult investment, right? And last but not least, consider alternative deal scenarios. So let me give you an example. Instead of offering a 50% discount on valuation, why not offer them, for example, at a certain valuation, but also maybe a preferential dividend, every year, 6% preferential dividend. And this preferential dividend will give you the same return as anyone else, right? It will give you the same return as getting a 50% discount on valuation. So this is extremely important, right? How do you position your deal, and how do you convey this message? And how do you consider these alternative deal scenarios? Okay. Oh, I have a question from one of the participants, Mark, over here. He has asked, if someone has just started his or her business, how would that person know that his or her business idea has a good valuation? Very good question, Mark. Valuation is subjective yet objective. Let me put it this way. Evaluation is subjective yet objective. How you can get a good idea, the simple answer to that is look at what some of your competitors have raised at. Okay, and we do have a huge database of data points within the company itself to enable the analysis of valuation. But if you can get information on what your competitors have raised at, that will give you a good idea of whether your business has a good valuation. Okay, I can go into another, also a long sharing as well on even how do you, whether you should talk about valuation at the start or the end of the meeting, right? But look at what your competitors are raising at, and you have a good idea. Or if your business model is so unique, then look at what the nearest competitor has raised at. Okay, and that is a good basis for valuation. Okay. All right, and the last one actually, consider debt financing. Yeah, so what I've seen also is a lot of companies, a lot of startups actually focus a lot on equity, right? Equity financing, getting shareholders and coming in. Likewise, from my friends in corporate finance, you do understand the concept of the cost of capital, right? The cost of debt is always lower than the cost of equity. Why is this the case? Well, simply put, debt holders have preferential rights over shareholders. And at the same time, debt holders also don't necessarily impede too much into your, or get too involved in the running of the business, which is why that cost of debt in corporate finance is always lower than the cost of equity. So do analyze the implications of debt and equity on your balance, on your cap table, and do consider debt, because debt is a lot cheaper. We are looking at 3-4 times cheaper. The cost of debt is 3-4 times cheaper. When should you use that? Use that, you may ask. When should you use borrowings? You may ask. The key point here is when you need additional working capital to expand and grow the business, that could be a good option for you. Okay, and there are alternative sources of debt as well, especially during this climate of low interest rates that have been occurring. What is available in Singapore, and I'm sure also in the rest of the other neighboring countries, is the temporary bridging loan. So for Singapore companies, from our own experience, we have gotten some of our clients, and recently we've even we've even got one of our SME clients funded almost $2 million in financing. The banks are offering rates now at a 50% discount as opposed to what has been offered before. Yeah, because there's a lot of impetus by the government to push these funds out. So right now we are looking at 2.5 to 4.5%. Previously it was double that easily, and this is until 30th of September. So this is our own experience with debt financing. So do consider that venture debt, PO financing, P2P funds as well. So in Singapore, we are one of the pioneers of venture debt within the Southeast Asian region. We have quite a few investors in venture debt over in Singapore. So that is a good source of funding. In the US, it has really taken off. Venture debt has really taken off, but not so much in Southeast Asia. But I do advise to consider debt and equity. Okay. So the next one is PO financing. So PO financing basically is purchase order financing. So when you have a purchase order coming in, potentially the financial institution could finance that. For P2P funds, what P2P is that it leverages the power of the crowdfunding to fund companies. So they get a return. So investors will get a return in return for giving or lending a company money. So they are not borrowing from a financial institution, but they are borrowing from crowds, right? So essentially it is crowdfunding. Okay. So yeah. What I also go to is top 5 tips in engaging with investors. Well, number 1, don't overcomplicate things, right? Keep things simple. As a business owner, as a startup founder, as SME owner, when you're raising funds, you might start to go into a lot of technical talk, right? Because you understand the business, right? But investors are not professionals in the business. Keep things simple. Keep them interested. Understand what they don't understand and address that. Okay. Second tip number 2, regular updates to keep relationships warm. Send them regular updates. Even if the investor has said no, don't stop. Okay, if they say no, don't stop. Just keep sending them updates. Oh, we've met this person today. Our revenue has increased 2x, 3x from last month. Number of active users have gone up 20%, 30%. So and so. Give monthly updates. How many? Oh, we just hired a new CTO and things like that, right? Thirdly, know the landscape. At what stage of the investment life cycle is the investor at? Okay, look for resources out there online, and if you're unsure, feel free to reach out to me as well. Know which investors invest in at what stage of the startup life cycle, right? Are they seed? Are they Series A, Series B, Series C? Because you don't want to spend the time engaging with an investor who is a Series B investor, but only because and your company is at the seed stage of funding, right? So that's something you don't want to do. Okay. Yeah. So fourth one, leverage on herd mentality. Get the first commitment, right? The moment you send investors updates, the moment you get your first commitment, things will start to move for you. Okay. So don't give up. Continuously get the first commitment. Keep all your investors warm. And number 5, know your metrics. Understand what drives your business. Understand what is key in revenue growth for you. So know your metrics as well. And I'll go into that a little bit later on. I have a question here as well. How should scientific researchers from Chengi, how should scientific researchers at universities evaluate the business potential of their work? Oh, very, very good question. Very good question. I think there is an element of work. This is actually, honestly, in my opinion, a bit difficult as well. There is an element of work that is that can be commercialized, right? And there is an element of work that will be difficult to commercialize. So the short answer to this is to understand and to, look at or to engage with investors with experience in investing in such fields and who have invested in deep technology startups before, or invested in pharmaceutical kind of scientific startups before. The reason being, many investors have different mandates, right? So you don't want to be engaging a investor with a mandate in e-commerce and consumer business in your field, right? And likewise, vice versa. So the business potential side would be something that they can give their inputs in if they are experienced as well, and they can bring you and the right connections to make the right connections, meet the right people to commercialize your work as well. But yeah, with every research endeavor, with every scientific endeavor, there will be a portion which is you're able to commercialize, and there will be a portion that is you're not able to commercialize. And I would like to highlight that it's important to reach out to the right investors, right? Because at times such endeavors, such companies take a long gestation period before we see commercialization come in. So because of this long period, you need an investor to constantly be with you on the side to be able to advise you accordingly. Okay. Okay. So yeah. So back to financial metrics. So like I mentioned, we do have this is basically a key summary of what financial metrics is. Gross margin, net margin, cash flow analysis. But in short, we do have another area that we are going into as well, which is this portion over here. Okay. So on our company side, we are able to advise on that. So if anyone, if you do have any questions on how you can get financial metrics, how you can get to understand the ratios of a company, please definitely feel free to reach out to me, and we can run your financials through our system, and we are able to advise accordingly and give you advice on that. Okay. Yeah, thank you so much. I think, yeah, we've ended on time. If there are any questions, please feel free to reach out to me as well. My number's over here. If you can take it down, just drop me a text and drop me an email as well. That's all. Okay. Thank you so much for everyone for attending today. I think I want to thank AWS and Skip for giving me this opportunity as well. And yeah, back to you, Danny.
Hey, Matthew. Thank you very much.